Welcome to The Explainer. Today, we are diving into a genuinely bizarre market rotation. Look, if you've been watching the tickers lately, you already know things are acting incredibly strange. We're seeing a market that's fundamentally split right down the middle, literally reacting to the exact same data in completely opposite ways, all depending on where you look. So here is the massive puzzle we're trying to piece together today. Why exactly is a cooling labor market pushing the Dow to absolute record highs while simultaneously just crushing big tech? It feels completely counterintuitive, right? Usually, when the labor market cools, we'd expect a broader market pullback across the board. But that is definitely not what's happening. To figure out why, we need to dig into the actual mechanics of this specific moment. To make sense of all these disconnected stories, here's our roadmap. We'll start with the macro seesaw, look at the great capital divergence, and track the data center migration. Then we'll hit micro movers and crypto, synthesize it all in the Goldilocks rebalance, and wrap up with upcoming market catalysts. All right, starting from the top, Section 1, the macro seesaw. You know, the term Goldilocks really hits the nail on the head right now. Wall Street is currently obsessed with finding a situation that isn't too hot or too cold. Now, a weak jobs report would normally spark panic, but right now, it is the just right temperature for the Fed. It's not hot enough to trigger inflation fears, but it's not cold enough to signal a deep recession. It's exactly, and I mean exactly, what the Fed wants to see so they can justify keeping their hands completely off the rate hike button. Picture an actual seesaw for a second. On one side, the U.S. added just 57,000 jobs in June. That is a massive miss compared to the 115,000 expectation, with unemployment sitting at 4.2%. Now that cooling labor market is acting as the perfect counterweight, lifting the pressure right off the other side. Because of that huge miss, the odds of a Fed rate hike plummeted from 29% down to just 18%. You can practically see the pressure easing. So the macro environment is cooling down, but where's all that money actually going? That brings us to Section 2, the great capital divergence. This is where things get wild. This macro seesaw is violently splitting the stock market into two completely distinct realities. On one hand, you have the Dow Jones hitting a fresh, historic record of 52,900. It's up over 1%, and it's being driven by defensive sanctuaries, primarily healthcare, which was the absolute best-performing sector. But on the other hand, you've got the tech-heavy NASDAQ totally slumping, dropping 0.8%, dragged heavily by information technology. And caught right in the middle, a perfectly flat S&P 500. So capital isn't leaving the market at all, it's rotating. It's moving out of tech and pouring into defensive value. If your portfolio is super tech-heavy, this is exactly why you're probably feeling some serious whiplash right now. If we zoom in on the NASDAQ slump, the gritty details show some major semiconductor exhaustion. The iShares Semiconductor ETF just dropped 5.6% for its second consecutive day in the red. And this isn't just one stock having a bad day, it's a domino effect. The contagion is spreading fast. We're looking at a massive 14.1% wipeout in SanDisk memory. Samsung Electronics is down 9.1%, and that's spilling right over into Tesla dropping 7.5% and Meta falling 4.9%. Equipment and chip makers like Teradyne and Lam Research are dragging the whole pack lower. The high-growth AI engine is clearly taking a breather here. But honestly, this tech story isn't just about numbers on a screen. It's turning into a physical crisis. Section 3, the data center migration. There is this crazy geopolitical shift happening right under our noses. As U.S. municipalities start seriously pushing back on these massive data center projects, big tech is aggressively relocating to find room to grow. We're talking about a $15 billion+ megalith shift over to India. Microsoft and Alphabet have each already thrown down over $15 billion. Meta, Amazon, and OpenAI are frantically expanding capacity there too. And the logic is pretty straightforward. Proximity dictates speed. India actually has the second highest number of ChatGPT and Claude users globally, so they absolutely demand that localized computing power. But this migration isn't exactly smooth sailing. Big tech is being lured in by what's basically a sugar trap of government catalysts. We're talking accommodating federal policies, incredibly cheap land, aggressive tax incentives, and subsidized water and electricity. It is an incredibly sweet deal for them. But on the ground, they're slamming into some intense local friction. Communities are pushing back hard. Locals are chafing over the strain on sparse shared resources like water and power. They're frustrated that projects are just forging ahead without public hearings, and they feel like public officials are completely unreceptive to their complaints. It's a classic, massive clash between top-down incentives and real ground-level realities. Let's step away from the big macro trends for a second and look at some absolute outliers. Section 4, Micro Movers and Crypto. Check out this number, 12,194. In an EV market that is frankly just brutal right now, Rivian is somehow defying gravity. They delivered over 12,000 vehicles in Q2, basically cementing their status as the EV survivor. They completely blew past their 9K to 11K guidance and even beat out their numbers from this exact same time last year. That kind of surprise locked in an 8.4% jump in their stock. Then you've got a massive 13% jump from a pretty quiet giant. Genuine Parts shot up 13% to become the absolute top performer of the session, vastly outpacing the broader market gains. It just goes to show, while all that flashy tech exhausted itself, traditional physical world businesses were there to absorb that rotating capital. And over in the crypto space, we're seeing some stark asymmetry, especially looking at the World Liberty Financial Project. The financial disclosures reveal a pretty clear divide. On one side, the project creators netted about $800 million. But on the other side, the retail base experienced a near total wipeout of token value. It's a really vital reminder of the deep disparities and risks involved in alternative assets right now. All right, let's tie all these threads together. Section 5, the Goldilocks rebalance. If you're trying to navigate this market, there are three main pillars you absolutely have to understand. First, cooling labor data is capping rate hike odds. The Fed is officially off the market's back for now. Second, capital is not vanishing, it's rotating. It is aggressively moving out of exhausted AI and tech stocks and into defensive sanctuaries like healthcare and reliable physical world businesses. And third, geographic pivots are pushing billions of tech dollars out of constrained U.S. markets and directly into heavily subsidized international markets, just to keep the AI engine fueled. Put it all together, and this is the Goldilocks rebalance in action. Markets aren't collapsing at all. Instead, investors are systematically de-risking their portfolios. They're moving away from high-growth tech dependencies, while simultaneously celebrating a macroeconomic cooling that protects the baseline of the broader market. That de-risking strategy? That's the ultimate takeaway here. It's a highly strategic, calculated transition to protect baseline wealth. Of course, the market never just sits still. That brings us to our final section, upcoming market catalysts. Here's what the week ahead actually looks like, and what could potentially disrupt or confirm this delicate rebalance we've been talking about. Monday starts quiet with the ISM Services PMI. Wednesday, we get a peek into the Fed's mindset with the FOMC June minutes. Thursday brings housing data and PepsiCo earnings, followed closely by Delta Airlines on Friday. But definitely mark July 14th next week on your calendar. That is the big one. This brief respite ends as the big banks release their results, which officially kicks off the Q2 earnings season. So this all leaves us with one massive question. Will the upcoming Q2 bank earnings confirm this delicate Goldilocks rebalance we just decoded, proving that this whole rotation was justified? Or will unexpected corporate weakness shatter the macro seesaw entirely? Keep a very close eye on those banking tickers next week because they definitely hold the answer. Thank you so much for joining me for this explainer. I really hope it brought some clarity to your market radar.